let's spend a minute talking about some alternative trading systems. And the first sort of alternative trading system, or the first way that people sort of trade, it would be something called algorithmic trading. And this refers to any sort of trading that has some sort of, formula or algorithm behind it. And index arbitrage is a standard example, meaning that there are 500 stocks on the S&P 500 and I can buy some sort of investment vehicle which tracks the S&P 500, or I can buy the 500 stocks that are in the S&P 500. And if it's the case that the value of this vehicle gets a little bit high, I can short sell that and I could buy the 500 stocks that underlie this trading vehicle until they match, and I make a few pennies or a few dollars in arbitrage. And so this is what's referred to as index arbitrage. There's lots of indices that can be traded, and there are obviously lots of underlying assets, and I have to make essentially 501 trades. I have to trade the index vehicle and all 500 stocks very, very quickly, and so I would use an algorithm to do that. The next thing to talk about is high frequency trading. And high frequency trading is usually, there's a number of things which are defined as high frequency trading, but the most common one is to assess whether or not I think there's going to be a number of buy orders coming or a number of sell orders coming. I do that by maybe being in a position to have the orders exposed to me, but I don't actually trade against those orders. And then because of co-location, meaning that my computers are in the exact same building as the exchange, I then beat those orders to the exchange. And so if you want to buy 100 shares, well, then I'm going to immediately buy the lowest priced 100 shares. And then when you show up a millisecond later, I then sell to you for a penny higher and I make a penny on 100 shares. And I do this all day, every day. I do this super high frequency. And what I'm going to do is I'm going to try to assess when a large order or even a small order is coming in, beat that order to the exchange, buy the very lowest priced shares, and then I then create what would then be the lowest offer and then sell to you when you arrive an instant later. Dark pools refer to any trading mechanism in which outside observers can't actually see the orders that have gone into the market. And so, for example, you can't see the limit order book, you can't see the best bid and offer, but they do report the trades after they have happened. They just don't tell you what the trades are before they happen. And there's essentially two kinds of these. There's more than two, but we'll talk about the two main kinds. The first is something called a crossing network, also called a matching market. And these are accessible only to specific kinds of market participants, those who actually buy and sell stock because they want to hold it or they want to get rid of it. They are not high frequency traders that we just talked about. They're not people who are looking to buy it for an instant and then sell it again. These are what we refer to as natural buyers of stocks, and this would be pension funds and mutual funds and endowments. There are also entities that have very high information content trades that are known to have done lots of research. And the idea is that if one of these high information content traders places an order in a transparent market, everyone will see that order and say, oh, this mutual fund's going to buy the stock, I better get in there pretty quickly. And so these mutual funds, these high information content traders, will attempt to execute their trades without anybody knowing they've executed them until after they've executed. And they'll use these things called dark pools. And the way it works is that one of these mutual funds or pension funds or endowments or other large portfolio will indicate that it wants to sell some stock. It'll indicate it to the crossing network, and the crossing network will wait for another buyer to come that they can cross this trade. And the way it works is once they have these two people who are interested in crossing, one's a buyer, one's a seller, they say, okay, what we're going to do is we're going to watch the rest of the market and we're going to see what the trades are for a 5-minute period. And at the end of the 5-minute period, we're going to execute your two trades, your two orders, your one trade, using the volume weighted average price or some sort of similar algorithm to determine the price. And what that means is that we'll observe all the other trades and we will weight those trades over this 5 minutes and we will cross your trade at the average price over the last 5 minutes. And the reason they do a volume weighted average price is it's very difficult for one of the two parties to then game the trade. If I want to sell, I'd like it to be at a really, really high price. And so if I can just buy a few shares to raise the price, then I can sell my big block at a much higher price. Or if I want to buy, I can sell a few shares to lower the price and my big block will trade at a lower price. But if I volume weight the average price at which the dark pool cross is made, then it is difficult to affect a price change large enough without really committing the funds to really affect what the cross will be. So this is why they use the volume weighted average price. And after the trade happens, after the cross is made, the crossing network dark pool then publishes that this trade happened, and it publishes the price at which that trade happens. The next type of dark pool relates to payment for order flow. And here's the idea. These are trades that occur generally for low information content trades, generally by retail traders. These are amateur traders, individual traders, people who are trading for their own account, and they are trading through some sort of brokerage site like Schwab or E-Trade. And here's the idea. The bid-ask spread is a function, one of the functions of bid-ask spread, and we've already talked before about some of the things that can determine the bid-ask spread. But one of the things that can affect the bid-ask spread is trying to avoid ex post regret. And here's how to think about it. Let's assume that I want to sell my house, and I say, I'll sell you my house for $300,000. And you say, $300,000? I'll take it. And I say, I meant $350,000. Because if it is the case that I'm in a market and I'm faced with market participants who know more than I do, will cause me to widen my spread. I want to sell at a higher price, and I'll only be willing to pay a lower price. And conversely, if I'm fairly convinced that the people against whom I'm trading don't have more information than I do, then I'm not so worried about being underinformed and selling at a price that's too low or paying a price that's too high. I'm willing to narrow my spread. And so another type of dark pool are dark pools that are affiliated with brokerage firms, and these dark pools pay the brokerage firms in order to execute against these brokerage firms' clients. And the reason they do it is because there is fairly good expectation that these will not be well-informed traders. And by paying for the order flow, by paying a tiny, tiny fraction of a penny in order to trade against these orders, I'm effectively narrowing the spread. So instead of buying at $118.36 and selling at $118.37, maybe I'm giving up a quarter of a penny on each side and I only have a half of a penny spread. But I'm willing to do that because I can continually still buy at the bid and sell at the ask. I can make half a penny all day long as opposed to more money, but I can do it more frequently, and there's a really good chance that the people against whom I'm trading don't know more than me, and all of a sudden the price is going to go way up if I just bought, or the price sold, or if the price is going to go way down if I just bought. And so another type of dark pool are these payment for order flow dark pools. They are designed to pay to trade against low information content traders, generally retail traders, with the intent of still buying at the bid and selling at the ask, buying at the low price and selling at the high price, providing liquidity for these traders, but at a narrower spread. The trader doesn't actually benefit from the narrower spread. It is the brokerage firm that receives this payment. The trader doesn't get the payment, the broker gets the payment, and this is another way that these brokerage firms can have zero cost trading, is that they are going to be paid for displaying their customers' orders in these dark pools for these payment for order flow trades.